mean, this notion that they're suddenly going to somehow go back to normal interest rates, whatever that is, or a normal balance sheet, whatever that is, man, those days are long gone.
This week's specials with Miles Franklin Precious Metal Investments. Type 2 American Silver Eagles for only $7.75 over spot, and 2-ounce mother and baby platypus coins from the Perth Mint for only $3.75 over spot per ounce. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Always nice to see you, Elijah. We got a lot to talk about.
Definitely. Now, last time we had you on, you were talking about how there could be a potential economic downturn this quarter, now the fourth quarter of the year. Now, looking at the stock market, we are seeing it potentially roll over. It's not making new all-time highs as it used to every day. So what is your take on what's happening in the economy this quarter?
Well, there's a couple things going on there. Speaking of GDP, a lot of us track the Atlanta office of the Federal Reserve always puts out this model they call GDP Now, where about a couple times a week sometimes, depending on how fast the economic data is coming out, they will update the current quarter, what they think U.S. GDP is at. And they just cut it again. I mean, now we're into the fourth quarter, but they're still trying to figure out third quarter GDP. We won't get that first guess for another couple of weeks. But that dude has just been cutting it and cutting it and cutting it and trimmed it again yesterday as we record this on Wednesday. We trimmed it again on Tuesday, all the way down to just 1.3%. So, where you and I, since last summer, June of 2020, have been talking about stagflation, that the lingering impact of all the shutdowns and everything else with COVID means we're not getting back to normal, whatever that was, anytime soon. While at the same time, all of the supply chain disruptions of trying to turn things back on and the inflation that comes from all of the rampant money printing was going to cause inflation. And the combination is stagnant economic growth with inflation. That's exactly suddenly where we are. I mean, if we're going to come in at 1% or whatever for the third quarter, and who knows what the fourth quarter will be. So all that discussion that we've had about stagflation and what that means, it seems to be coming to fruition. As in terms of the stock market, I see Chairman Powell trying to thread a very small eye of a needle here. He's got several major problems he's trying to manage all at once. In terms of the bond market, he's got to keep interest rates down, got to keep long rates down. We can't have 4% and 5% treasuries and mortgage rates and everything. I mean, just can't. So they support the bond market by QE, right? Which now they want to try to taper. Well, the other problem he's got is they've created so much cash, right? Not only just in the last year, but in the last several decades, that now there's so much cash floating around on a nightly basis looking for a home that they had to start paying 5 basis points on excess reserves back in June. And that's why when you see these numbers about reverse repo, $1.5 trillion of daily volume of reverse repo, that's $1.5 trillion that's looking for a place to be parked overnight. If the Fed wasn't paying this little measly 5 basis points on it, then that money, that cash should be out there looking for traditional alternatives. And because there's more cash looking to be parked than there are places to park it, we'd be in negative short-term interest rates at this point. And the Fed can't allow that. So Powell's got this two-pronged problem. He's got all this cash, right, that he's got to do, that has to be parked someplace. He's got rampant inflation from all the money printing, but he's got to keep interest rates low and all this kind of stuff. And so what I think he's trying to do with this taper plan is if they can step back from the bond market, then maybe that that the buyer will come from some, to replace them will be some of this cash, this $1.5 trillion that's laying around going into excess reserves. And if you can do that, then maybe you'll draw that down a little bit. And if you can pretend like you're actually stepping back, then maybe the dollar will catch a bid. And then maybe if the dollar catches a bid, it'll go into a sustained rally. And if that's the case, maybe the commodities will fall. And if that's the case, maybe inflation will pull back. And that's kind of this needle he's trying to thread. In the meantime, just even discussing taper, you start getting less liquidity and the stock market starts to roll over. So anyway, there's your 3-second answer to your question that I actually drew out in 3 minutes. The stock market is starting to fade because the Fed is, as they say, withdrawing the punch bowl, or at least going to try to.
Now, is that really what the Fed is doing, you think, if they are going to taper? Because you mentioned how it might be that it just appears that they're tapering, but they're not really.
Well, and see, that's the thing. But you look at the chart, Elijah, you go back to March or April of 2020, after the COVID-related crash. March 20th is when they announced all of this, this alphabet soup of new programs and QE, 120 billion a month and all that kind of stuff. And then S&P 500's gone nothing but, up at a straight line, 45-degree angle up on a chart ever since. Occasionally, maybe once a month or once every 6 weeks, a little pullback, typically tapping its 50-day moving average, maybe for a day, and then bouncing and just keeping on going up. Well, as soon as it became obvious, the Fed was going to try to go this route and try to start withdrawing, some of their buying, well, all of a sudden the stock market kind of rolled over, broke down through its 50-day, then tried to get back up and failed and rolled over this time. And now it's back even below its 100-day moving average and failing to get back above. So technically, it looks like people are, taking a cue, looking at what the Fed's going to do and taking it as their cue to say, well, you know what, maybe the easy money here is done for a little while. Let's let this come in a little bit and maybe look for a chance to get back in. So the stock market may continue to decline for the next, maybe through the end of the year. Maybe not like a 50% crash. I don't see that. But it could end up a full 10% pullback by the time it finally turns again.
And you think even with that, the Fed will continue to be hawkish? Because it seems like, I guess I'm a bit skeptical, because it seems like with any sort of downturn in the stock market, the Fed does not want that. So it seems like they just push more liquidity into the system.
Right. And that's the thing. What Powell's trying to fix, that needle he's trying to thread, is I think again, what that money, that overnight money that would normally be in commercial paper and all these other real short-term instruments, that is now getting quarantined almost every night, in this reverse repo thing. That's not necessarily 2- and 5-year Treasury note demand. Okay. But I think what Powell thinks is if he can pull back $30 billion a month of money printing over the next couple of months, that maybe at least that 30 billion, that slack will get picked up by some of that excess reserve cash. Okay, we'll go ahead and, I believe this transitory thing. And so some of that cash keeps rates low anyway, and maybe that provides a floor to the stock market. I'm just guessing at what his motives and his intentions are at this point, because like you mentioned, Elijah, you and I both know this. They cannot allow, this notion that they're going to somehow go back to normal interest rates, whatever that is, or a normal balance sheet, whatever that is. Man, those days are long gone. They proved that to us back in 2018, right? They could let the 10-year note get to 3% and everything. The stock market started to crash like crazy. They can't do that. So he knows that. Whether they'll ever be able to taper to zero, I guess, will be a function of if that demand for U.S. Treasuries does materialize from some other source other than the Fed.
And with the debt ceiling looming within the next few weeks, the media is making a huge deal about this and all of that. Do you think this is actually any sort of threat that there could be some sort of default or anything like that? Or will it just be raised again? Yeah,
it's just the same old jazz, Elijah. I wrote about this last week. I called it the theater of the absurd, which that term came to me. And I thought, there is such a thing as theater of the absurd. And I looked it up, and it talks about, it's like a late 1950s French art form where people start basically talking in circles and you end up at the end right where you began. Well, that perfectly describes the debt ceiling debate that they have every 6 months or whatever. And that's what it'll be again. I'm sure they'll pretend and play chicken and say, oh, we're not. And then magically they'll come up with something to extend it again. I think probably more important that most people don't realize. They hear the term debt ceiling and think of it in its original connotation, which when that thing was first dreamed up a couple decades ago, it was a hard number. We will not allow the national debt to go past $5 trillion or something like that. And once you got there, they had to pass an extension to $6 trillion. Well, you didn't used to add that much onto the debt that fast. And so, a couple of years goes by and now we got to, extend it from 6 trillion to 7 trillion. Well, then we got to the financial crisis and they'd extend it, $500 billion and it'd be all this hubbub, hullabaloo. And then, they'd add on $500 billion in debt in like 4 months. And all of a sudden, it's like a debt ceiling again. Well, then some people started catching on and going, wait a second, hold on just a minute. We just did this 4 months ago, and you've already spent it like you'd have with your kids. Like, wait, it just gave you some money. So that what Congress then did, this is, 2012 or 13, they said, well, the hell with this. The debt ceiling now is just a date beyond which we can't borrow. And so that's where this all comes up now, because the last time it was extended through the end of the U.S.'s fiscal year, which is September 30th. And then, they paraded Janet Yellen out last week and said, well, I can only do these extraordinary measures until October the 18th. So now they've got this arbitrary deadline of October the 18th. But it's not that the debt ceiling is $29 trillion that they can't exceed it. It's just that they've given themselves, again, this is the theater of the absurd. They've given themselves a ceiling of a date so that when they do pass it again, it'll be, okay, well, we can borrow again through the end of the next fiscal year, which is just meaningless. And so, yeah, you wonder, will they fix it? Of course they will, because it's just meaningless. It's just politics. Make team A look bad, team red looks bad for a minute, then team blue looks bad for a minute, and they kick it back and forth just to keep us all at each other's throats and keep themselves in power. But I'm sorry, maybe that sounds a little cynical, Elijah.
Well, it is interesting how, it does seem like a lot of show. And even these proposals that are coming up, like a $1 trillion platinum coin, that's just ridiculous. And even Janet Yellen recognized that as just a gimmick, a way, it's just printing money. And so your perspective on that, these things that are coming up where it's just like, what kind of an answer is that? Just print the money to pay the debt?
Yeah, which is what they're doing, right? But again, it's like the debt ceiling thing. Well, we don't want to really call it that. And so if we dance around, people will pretend that all this is normal. And the key to promoting normalcy, you've got to have confidence, right? The whole end of the day, that's what it's all about. I think we talked about this the last time you and I spoke. Nixon closed the gold window and suspended the convertibility of dollars into gold in 1971. And so the US dollar and all the other major currencies are all just script, created now digitally, they're just zeros and ones even. And the only thing backing them is confidence. You are going to use the dollar as a medium of exchange only if you have confidence that it's going to retain some value, so then you can take those dollars and do something else with them. When it all gets crazy, Weimar Germany stuff is when you lose confidence in the value of that currency. And then you just demand more and more and more because, it's inflating away 20% a day, that sort of thing. So the only thing they have now is confidence in the existing system. Would they ever do this $1 trillion coin thing? These crazy modern monetary people in their ivory towers on college campuses seem to think that feasibly is a possibility, and as they always used to say, that's like theoretical physicists can always come up with a way that, you can dangle an elephant off a cliff, that sort of thing. But common sense tells you can't do that. And it's the same thing with this platinum coin thing. These economics professors and doctors and PhDs and stuff. Oh, yes, that's then the Constitution would seem to allow it, Elijah. And so it would be very simple. They could just mint it. And then the Treasury sells it to the Fed for $1 trillion credit. And voila, It's absurd. And again, like theoretical physics, you could ask anybody. I asked my wife yesterday. I said, they got this idea. They're going to mint a coin, say it's worth $1 trillion and sell it to the Fed. She goes, what? That's the craziest thing I've ever heard. Rational people in an actual rational marketplace understand that. And if they tried it, getting all the way back to why I'm telling you all this, it just destroys confidence. I mean, people would go, wait a second, I'm not using the dollar anymore. What are they doing over there? And that's why they won't do it. But who's to say, man? I mean, the grasp of economic reality that, all these bureaucrats in Washington, people never had a job outside of Washington, D.C., grasp of economic reality is pretty, light amongst that crowd. So maybe they'll give it a try. Oh, my gosh. If they do, Elijah, well, things are going to get interesting for us in the precious metal space. That's for sure.
Definitely. And I think that the key of that loss of confidence in the dollar, we are starting to see that with the inflation that we're seeing. But even as we've been seeing inflation, the value of precious metals, at least on the, if you look at the spot price, then it has been falling for the last quarter. Your perspective, if you want to give us an update on what we've been seeing this last quarter, the third quarter of 2021, for gold and silver, both of them have been falling, at least in the paper markets.
Yeah, for all year, Elijah. That's the thing that's so crazy. If you want to, from a traditional fundamentalist point of view, I guess, I think the market, if you will, the hedge funds, the people that are the institutions actually buy the futures contracts, right? The paper markets. I think they've all been convinced by Powell that this transitory thing is true. And therefore, when the 10-year note is yielding 1.5%, but inflation's 5.5%, so that's a negative real yield of negative 4%. They're like, whatever, that's transitory too. And so the powers that be that would move the price upward have just not cared. And so you just continually just seeing it just get washed back and back and back and back. Now, again, I can't have a discussion about longer term stuff in the precious metals without bringing up confidence, like you said. And I think it's pretty clear going back to when Nixon closed the gold window and the introduction of gold futures in January 1975. I think it's pretty clear that all of that was done to create a false supply of gold. Because really a pretty finite supply of physical metal, but there's almost an infinite supply of all these different derivatives and unallocated accounts and ETF shares and all this other stuff. So as to, dilute and seem much more broad the actual amount of metal. And if you have much more supply than there really is of anything, then you're going to have a kind of a falsely determined price that's too low. And that benefits those same central bankers that are trying to inspire confidence too. You got to make sure you keep that in mind because again, all of this money printing that has taken place, I mean, $120 billion a month that we know of, but that's not just the Fed, it's the ECB, it's the Bank of Japan, the Bank of England, they're all doing the same thing. If gold was soaring in response to that, it would betray confidence. But if gold's falling, so I guess maybe all of this money printing is not such a bad thing after all. So there's always that kind of perverse incentive at the central bank level to make sure gold prices aren't soaring as well. And that obviously that has a part of it too. But at the end of the day, you need more buyers than sellers of anything to make the price go up. And because Powell and his Fed have convinced, the people that play in that market, the derivative market, that all of this is transitory, there are just not enough buyers, not enough buying interest of COMEX gold futures to make the price go up.
And I think that's so key because, if you look at the physical demand we're seeing on the retail side, at Miles Franklin, we've had some of the busiest times in our history. At the beginning of the year and also just when the price dropped recently. So your perspective on that huge demand we're seeing, I know this is anecdotal evidence, right? But it's like we're seeing so much physical demand, but the spot price is just falling.
Yeah. Well, and I'd back that up too. A good friend of mine runs another big online dealer. So it's not just at Miles Franklin. And he told me back on Monday that the demand for physical metal is the greatest it's been all year, absent that last weekend of January in early February. And that break below 22 just drove everybody into buying more silver. And you get back to that point. I mean, what is it now? Elijah, well, we had 22 plus in the futures market, but can you buy an Eagle or a Maple or anything for anything less than 28? Okay, or even a generic round for less than 26. So what's the actual price? What the derivatives are trading at, or what the actual metal is trading at. And that bifurcation of the market is what kind of betrays the fact that you're not discovering a physical metal price in the futures market. You're discovering a derivative price. And so much of that is just done by computers that trade, intraday, trying in high frequency trading based, off of what the dollar index is doing, things like that. So anyway, what I've told people all year long, and I've had to, I don't want to say resort to this, but this is a kind of a mantra that we had back in 15 and again in 17. And that is, the daily price that you see fluctuates, right? And, if you've got to sell some because you've got a family emergency or something, then that impacts you. But at the end of the day, man, every single day, whether the price moves up or down or not, the value of my physical metal, the reason why I bought it in the first place, all of that's unchanged. I mean, in actually getting stronger by the day as, these central bank policies make them that way. So price is one thing. It's, and it's determined through the trading of these futures contracts. That just won't go on forever. In the meantime, hey, if it's going to be, in our view, underpriced, then you just keep buying some, just keep adding to your stack of metal. That's never going to hurt you in the long run. Definitely.
Well, Craig Hemke, we really appreciate your time today. Before we let you go, did you want to share with the viewers any last thoughts you had and where people can find you online?
Well, let's see what happens. This coming Friday, we've got the next jobs report. The last jobs report was dismal, and that was supposed to indicate that maybe the Fed wasn't going to be tapering, but now the Fed's tapering anyway. So I would suspect that doesn't matter what the jobs report shows on Friday, that discussion is going to continue. That's going to actually become the news by the time we get to the next FOMC in early November. And then they're probably going to give a run by December to start paring it back. So we'll watch the bond market. We'll watch the dollar. I suspect this might all be ultimately sell the rumor, buy the news sort of thing for the precious metals. And then we'll actually rally into the fourth quarter and through the fourth quarter, maybe not all the way back to even on the year, but at least give back some of what we made the last couple of years, and then we'll see where 22 takes us. We talk about this all day, every day at TF Metals Report, and have been doing so for about a dozen years now. And we're going to continue to do it. And if you want looking for some like-minded people to interact with and learn more about the precious metals, I think my site's about the best place to do it. So encourage everybody to check us out, tfmetalsreport.com.
Fantastic. And if our viewers would also like to listen to more of these interviews that we'd be doing with you and all our other guests, go to libertyandfinance.com and sign up for our free newsletter. Craig, once again, thank you so much for your time.
Always good to see you, Elijah.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.